This pie chart shows the exact breakdown of the Corporate Financial Reporting syllabus. Section A, covering Indian accounting standards, commands a massive 25% of your total exam marks. Under Ind AS 34, we do not calculate income tax by looking at a single quarter in isolation. The standard mandates that interim reporting must reflect the estimated weighted average annual tax rate for the full year. Consider a scenario with a 620 lakh brought forward loss, a quarter 1 profit of 650 lakh, a quarter 2 profit of 360 lakh, and a quarter 3 loss of 160 lakh. We also have a total second half profit of 720 lakh and a 25% tax rate plus a 10% surcharge. The most common mistake students make is applying the 620 lakh brought forward loss exclusively to quarter 1. Instead, that tax benefit must be distributed across the full 12-month reporting period. Because the tax code assesses corporate performance annually, our interim accounting has to predict the full year's outcome before we can lock in a single quarter's expense. Step 1 is calculating the estimated total annual pre-tax profit by aggregating the performance of all 4 quarters. But if you review the data carefully, quarter 4 is not explicitly listed. The examiner gives us H2, the second half of the year, creating a trap for those who assume H2 is synonymous with Q4. We resolve this structurally. The second half, 720 lakh, is quarter 3 plus quarter 4. Since quarter 3 is a 160 loss, quarter 4 must be 880. We then sum quarter 1, 2, and the second half to reach 1,730 lakh total profit. Finding the true annual profit requires unpacking aggregated data. Getting this number right early prevents compounding errors in the subsequent tax steps. We use that estimated total profit to compute the actual annual tax liability. This block represents our 1,730 lakh profit. Deducting the 620 lakh brought forward loss leaves a 1,110 taxable base. Multiplying this by our 27.5% combined rate gives a 305.25 lakh annual tax. Dividing that tax by the initial 1,730 profit outputs a 17.6445% effective rate. This percentage is what we will apply to every subsequent calculation. It ensures the tax burden is distributed proportionally, regardless of the seasonal volatility in each individual quarter. In the final calculation phase, we allocate the tax by applying that effective rate individually to each quarter's pre-tax profit. Try calculating the tax expense for quarter 3 yourself. The result is counterintuitive, so pause the video and test your math. Here is the correct calculation. We take the quarter 3 loss of 160 lakh and multiply it by 17.6445%, yielding negative 28.23 lakh. Structurally, this operates as a tax credit, a specific financial saving generated by operating at a loss during that window. Ind AS 34 dictates that we recognize the tax benefit of a loss immediately in the interim period it occurs, rather than delaying it for a year-end reconciliation. Defensive exam strategies require you to verify your math. Before finalizing your answer, cross-check the quarterly allocations by summing them back together. Applying the effective rate yields Q1 at 114.68, Q2 at 63.52, a Q3 credit of 28.23, and Q4 at 155.28. Summing these resolves to exactly 305.25 lakh, matching our annual calculation. Finally, structure this data into a clean 4-column matrix for your exam response. Mastering this annual first, quarterly second logic ensures precision in your financial reporting and secures full marks on this complex standard.